Every single day in 2026, another department store is closing its doors for good. Macy's, JCPenney, Forever 21, Francesca's, Eddie Bauer. The anchors that built America's shopping malls are disappearing at a pace that defies comprehension. In just the first few months of this year alone, over 2,000 stores across the nation have announced closure plans. Without these anchor stores, the malls collapse. But what most people don't understand is that this isn't a natural death. It's not some inevitable consequence of e-commerce winning the retail war. It's the result of a calculated economic strategy that's destroying the very foundation of retail real estate ownership. And the winners in this collapse are making more money than ever before. To understand how this is possible, we need to go back to the beginning. We need to understand what made shopping malls the dominant force in American consumer culture for nearly 50 years. The shopping mall as we know it today didn't emerge from pure genius or inevitable market forces. It was built on a specific economic model that required absolute control over one critical element, the anchor store. An anchor store was a department store, typically a Macy's, JCPenney, or Sears. These weren't just stores, they were gravitational forces. They pulled people into the mall. A family would drive to the mall because Macy's had a sale. They would park their car in the lot. Once inside, they would walk past the 100 smaller tenants, the clothing boutiques, the food courts, the jewelry stores, the shoe shops. And every single one of those tenants paid rent to the mall owner for the privilege of capturing customers who were originally drawn by the anchor. This was the genius of the shopping mall business model. The mall owner never wanted to sell products directly. They wanted to own the real estate and extract value from every transaction that happened within it. The anchor stores were the customer acquisition cost. The small tenants were the profit center. The economics were staggeringly simple and effective. The anchor stores operated on razor-thin margins, typically 2 to 5% profit on revenues. Some operated at actual losses, accepting lower profits because they understood that their presence in the mall generated foot traffic that benefited their other locations nationwide. A Macy's store might lose money on its mall location, but it was worth it because that store brought 5,000 to 10,000 customers per day through those doors, and many of those customers would spend money at the Macy's downtown location or in other regional stores. But for the mall owner, the anchor stores served a single purpose. They brought people through the doors, and once people were inside, they spent money. In 1990, shopping malls generated over $800 billion in annual sales. By the year 2000, that number had grown even larger. The mall owner's profit model was straightforward. Collect base rent from the smaller tenants, typically ranging from $30 to $50 per square foot. Annually, collect percentage rent on sales above a certain threshold, usually 3 to 5% of revenues, charge common area maintenance fees for the upkeep of parking lots and corridors, and depend entirely on the anchor stores to generate the foot traffic that justified all of it. This model worked flawlessly for decades. The mall owner's profit margins could reach anywhere from 15 to 30%, depending on the property's location and quality. A well-positioned mall in an affluent suburb could generate annual returns of 15 to 20% on the total investment. For a property worth $500 million, that translated to $75 to $100 million in annual profit. Consider that a typical mall owner might collect base rent from 300 smaller tenants at an average of $40 per square foot on 200,000 square feet of space, generating $24 million in annual rent. Add percentage rent, averaging another $5 million from strong-performing tenants, common area maintenance, fees of $8 million, parking revenues, and percentage revenues from food courts and entertainment venues. A moderately successful mall could easily generate $40 to $50 million in annual gross revenue, with operating costs of $15 to $20 million, leaving net operating income of $25 to $35 million annually. And because these were real estate investments with stable, long-term leases, they were considered safe assets. Banks loved them. Pension funds owned them. Wealthy families built dynasties around shopping mall ownership. By the early 2000s, Simon Property Group had become the dominant force in the industry, owning or controlling nearly 100 malls across the United States and hundreds more internationally. The company was treated as essentially recession-proof, a stable generator of wealth across decades. Then something shifted. Not all at once, but gradually, then suddenly. The anchor stores began to struggle. Macy's started losing market share to specialty retailers. JCPenney couldn't compete with big box stores. Sears, once the most trusted name in America, began its long decline into bankruptcy. And as the anchors weakened, something unexpected happened. The mall owners didn't respond by reinforcing the model. They didn't invest heavily in the e-anchor stores or work to stabilize them. Instead, they watched. They waited. And when the time was right, they began to systematically dismantle the entire structure. Here's where the brutal calculus of modern real estate becomes visible. A shopping mall owner isn't actually invested in retail success. They're invested in real estate values. The building itself is the asset, the tenants are temporary. The anchors are negotiable. By the mid-2010s, as online shopping began to accelerate and anchor store revenues declined, mall owners faced a choice. They could fight to save the traditional mall model, or they could recognize that the anchor stores were becoming liabilities rather than assets. When a Macy's agreed to close one of its mall locations, the mall owner didn't lose a tenant. They gained an opportunity. That empty anchor space represented potential for redevelopment. That freed up real estate could be repurposed. And most importantly, that vacant anchor store meant fewer small tenants would renew their leases. Foot traffic would drop further, rents would decline, and eventually, the entire property could be redeveloped into something completely different. The first major wave of closures began around 2017. Macy's announced plans to close over 100 stores. JCPenney started its own rounds of shutdowns. Sears, once a titan, began its liquidation. But here's what's crucial to understand. The mall owners weren't panicking. The largest and most sophisticated operators like Simon Property Group were actually preparing for this moment. They had the capital, the expertise, and the long-term perspective to weather the storm and profit from it. The smaller, regional mall owners did not. They were trapped. They depended on those anchor stores to justify rents and maintain occupancy among the smaller tenants. When the anchors left, the small tenants fled. Within months, a previously stable mall could become a ghost mall. By 2020, the pandemic accelerated everything. Stores that were already struggling closed overnight. Rent payments dried up for months. Mall owners who were leveraged against their properties suddenly faced insolvency. Some major regional operators simply stopped paying mortgages, waiting for lenders to foreclose. But the largest operators, the ones with massive balance sheets and diversified portfolios, used the crisis as a buying opportunity. They purchased distressed properties at pennies on the dollar. They consolidated their holdings. They used the crisis period to negotiate better terms with their remaining tenants, extend leases at lower rates, and reposition their properties for the post-pandemic world. They emerged from the pandemic stronger than ever. By 2024 and 2025, these mega operators were using their accumulated capital to acquire premium properties at scale. Simon paid $512 million to take over the Brickell City Center Mall in Miami, a property that demonstrated the value of trophy assets in the right location. This is the key dynamic that most people miss when they talk about the death of shopping malls. It's not a universal decline. It's a concentration of power among the largest players combined with the systematic elimination of everyone else. Fast forward to 2025 and 2026. Simon Property Group, the largest operator in the industry, accumulated $4.8 billion in real estate funds from operations in 2025 alone. This isn't profit on a few hundred million in revenue. This is the actual cash flow generated from their portfolio of over 300 properties worldwide. They controlled over 250 retail properties in the United States and multiple dozens internationally. Their occupancy rates exceeded 96%. They were posting record profits quarter after quarter. They raised their quarterly dividend from $2.05 to $2.15 per share, a 9.8% increase year over year. But at the same moment Simon was posting these record results, over 1,000 American shopping malls sat empty and abandoned. They were scheduled for demolition. Hundreds of anchor stores were closing every single month across the nation. Over 2,000 store closures were announced for 2026 before the year was even halfway complete. The paradox isn't actually a paradox. The market is working exactly as designed. It's just that the design benefits only the winners, and there are fewer and fewer of them every year. To understand the economics of mall ownership in this environment, you need to understand who can actually survive. A typical shopping mall requires substantial capital investment. The average construction cost for a new mall in the United States is $400 to $600 per square foot, and that's up 15% from 2020 due to inflation. For a 1 million square foot mall, that's $400 million to $600 million in initial capital investment. But construction is just the beginning. Annual maintenance and operational costs typically demand 2 to 4% of the property's value. For a $500 million mall, that's $10 to $20 million per year, just to keep the lights on, maintain the HVAC systems, handle property management, pay insurance, and cover security. When a mall is healthy and fully leased, these costs are easily covered. Base rents from small tenants plus common area maintenance fees generate enough revenue to exceed these expenses significantly. But when foot traffic declines because the anchor stores have closed, when vacancy rates climb above 15 or 20%, those fixed operational costs suddenly become crushing. A mall owner might be collecting rent from only 70% of their tenants while still maintaining the parking lot, the corridors, the climate control systems, and the entire infrastructure. They're essentially paying money every month to keep a building open that isn't generating sufficient revenue. This is where the bifurcation becomes complete. Large operators like Simon can absorb these losses because they have hundreds of properties. If one mall is underperforming, it's offset by the profits from 10 other properties. Simon's portfolio strategy is sophisticated. They identify their A-class malls, the premier locations with strong anchors and high-traffic demographics, and they invest aggressively in upgrading these properties. They spend hundreds of millions every year on redevelopment. They add luxury boutiques, upscale dining, entertainment venues, and experiential retail. These A malls become even more profitable. Simon controls 12 locations that generate over $100 million in net operating income every single year. These are the financial engines that fund everything else. Simultaneously, Simon has identified their B and C class malls, the secondary and tertiary properties. For these, they've adopted a different strategy. They don't fight the decline. Instead, they allow them to become redevelopment opportunities. They acquire distressed properties, wait for tenant leases to expire, then reimagine the real estate entirely. Some become mixed-use developments with apartments, office spaces, and hotels alongside retail. Others are downsized to lifestyle centers focused on dining and entertainment rather than traditional retail. Some are simply demolished and the land is sold. From Simon's perspective, these aren't mall failures. They're portfolio optimization. The real estate itself is the asset. What's on it is secondary. But for the regional and independent mall owners, this is impossible. They typically own one or two properties. They can't absorb a major anchor store closure. They can't redevelop or reimagine the property if they lack the capital or expertise. They're trapped in what economists call a restructuring bind. They own a property that's becoming increasingly difficult to lease, generating declining revenues, but still consuming significant maintenance costs. If they try to sell, they'll find very few buyers, because the market knows the fundamental problem. The mall's economics are broken. The price they can command will be far below what they need to break even or recover their investment. If they hold, they're paying millions every year to maintain an asset that's not generating returns. This is precisely the situation playing out across America right now. In 2026, major retailer bankruptcies continue to accelerate in ways that seem almost designed to target mall-based retail. Francesca's, a fixture in malls across the country for decades, filed for Chapter 11 bankruptcy protection in February and is conducting going out of business sales at all of its roughly 400 stores. The company had been struggling with high debt loads and shifting consumer habits, but the final blow came when mall traffic declined below the threshold needed to justify store economics. Eddie Bauer filed for bankruptcy and announced that all 175 of its stores in the United States and Canada will close by April 30, 2026, unless a buyer steps in to save them, which no one did. Saks Fifth Avenue, historically a luxury anchor that had thrived in premium malls, announced 20 store closures due to weak luxury spending from wealthy customers and dangerously high leverage from previous acquisitions. JCPenney, which was already struggling having filed for bankruptcy just 5 years earlier, continues to close additional locations as malls deteriorate and foot traffic drops below sustainable levels. Macy's is in the process of closing 150 stores by the end of 2026, with at least 66 stores closed in 2025 alone, effectively shrinking from over 500 stores to less than 350. These aren't isolated incidents from different companies facing different problems. They're systemic. They're the culmination of a business model collapse that was decades in the making, now reaching its terminal phase. For the mall owners watching this unfold, the calculus is harsh. If you're Simon Property Group or one of the other mega REITs, you're actually thriving. Your A-class properties are generating record occupancy rates and increasing foot traffic. Your B and C-class properties are either being redeveloped into mixed-use destinations or liquidated for land value. You're raising capital, posting record profits, and expanding your portfolio. Your shareholders are happy. You're winning. But if you're a mid-sized or regional mall owner, you're facing existential pressure. Your property that was valued at $300 million 5 years ago is now worth $150 million, if you can find a buyer at all. The anchor stores that were generating $50,000 per month in rent are now gone entirely. Your occupancy rate has dropped from 85% to 40%. Your annual maintenance costs haven't changed, but your revenue has collapsed. You're burning cash. You're looking at years of mounting losses before the property becomes valuable as redevelopment land. Many of these owners are choosing to walk away entirely. They're defaulting on mortgages. They're allowing lenders to take possession. They're filing for bankruptcy protection for their ownership entities. The commercial real estate market is experiencing silent defaults and strategic abandonment at a scale not seen since the great financial crisis. The numbers tell the story with brutal clarity. United States shopping mall vacancy reached 12.3% in the first quarter of 2023 and has continued to climb since then. This doesn't sound dramatic until you understand what it means. 12.3% vacancy rate across 1,000 malls with a combined gross leasable area of 1.8 billion square feet means approximately 220 million square feet of empty retail space. That's space that still requires maintenance, still requires utilities, still generates property taxes, but generates zero revenue. For a small or mid-sized mall owner, this is catastrophic. For Simon, it's a feature of the market, not a bug. What's particularly fascinating from an economic perspective is how this has changed the dynamics of mall ownership itself. Traditionally, mall ownership was considered a stable, defensive real estate asset class. Pension funds owned malls, insurance companies owned malls, family offices owned malls. It was a predictable, low-risk way to generate steady returns from real estate. But the modern shopping mall market has become entirely different. It's now dominated by a small number of highly sophisticated, capital-intensive operators who can leverage technology, data analytics, and strategic portfolio management to thrive in a declining market. This has created enormous barriers to entry for anyone else. The average mall owner today must have access to billions of dollars in capital to execute redevelopment strategies, the expertise to manage mixed-use portfolios, the data analytics to identify A versus B versus C class properties, and the scale to absorb losses across a portfolio. An individual investor or small company can't compete, they can't hire the expertise, they can't access the capital markets, they can't diversify risk across hundreds of properties. The industry has bifurcated so dramatically that there are now essentially only two categories of mall owner: the mega REITs, like Simon, that are thriving, and everyone else who are struggling or failing. The middle has been eliminated. This dynamic is also reshaping the entire retail landscape. Brands understand that they can no longer depend on traditional mall locations for success. Forever 21 closed all 364 of its stores and filed for bankruptcy. Liberated Brands, which operated 8 mall-based fashion brands including Volcom, Billabong, and Quicksilver, liquidated all 122 stores after filing for Chapter 11. These were major retailers, but they couldn't survive in the new mall environment. The foot traffic simply doesn't exist anymore. Rents are declining, which means landlords are desperate to fill space, but the desperation also means quality tenants have options. They can negotiate better terms, shorter leases, or move to lifestyle centers and outdoor retail destinations instead. The most successful mall retailers now are typically either luxury brands targeting ultra-high net worth customers in A-class malls, or experiential concepts that provide something e-commerce cannot replicate. This is why Simon is investing hundreds of millions into experiential retail. They're adding upscale dining, entertainment venues, art installations, and entertainment experiences to their A-class malls. They understand that traditional shopping is no longer the primary draw. The mall must be a destination for lifestyle and experience, not just product consumption. The economics of this are different. It requires higher-end tenants paying premium rents, but it also generates significantly higher foot traffic and higher sales per square foot. The data on this is striking. Simon Property Group's portfolio saw retail sales per square foot increase 8.1% from 2024 to 2025, despite overall retail sales remaining largely stagnant. This is only possible if you're curating an entirely different tenant mix and customer experience. Simon's A-class properties are not struggling, they're thriving. But this is only possible because they're willing to let their C and D-class properties die. From an investment perspective, the modern shopping mall market presents a paradox. For the largest institutional investors and REITs, shopping malls are becoming more profitable than ever. Simon Property Group's market capitalization has tripled since the start of the pandemic, from $20 billion to $68 billion. The company is posting record profits, maintaining occupancy rates above 96%, and generating $4.8 billion in real estate funds from operations annually. Institutional investors are recognizing that in a bifurcated market, the winners are incredibly profitable. The concentration of wealth in fewer properties controlled by more sophisticated operators actually increases profitability per property. But for the broader commercial real estate market, this is creating systemic risk. You have hundreds of mid-market and smaller malls that are deteriorating, generating negative cash flow and becoming financial liabilities for their owners. You have thousands of small retailers who have closed stores because the malls they occupy are no longer viable. You have communities where the traditional shopping mall was the economic anchor, and its decline is cascading through the local economy. Property tax revenues are declining because real estate values have dropped so dramatically. Local governments are facing budget crises because they depended on tax revenue from malls that are now worth a fraction of their former value. This is the cost of the market's consolidation. The winners are winning decisively. Simon spent roughly $1.5 billion on more than 20 redevelopment projects in 2025 and plans to spend another $500 million on additional projects in 2026. This money is creating beautiful, profitable, experiential destinations, but it's also accelerating the decline of every other mall that can't compete at this level. The market is sorting assets into winners and losers with ruthless efficiency. There's no middle ground. There's no stable, moderate profitability for regional operators. You're either at the top or you're failing. The broader economic implications of this are profound. Shopping malls employ over 4.2 million people directly, with an additional 12.8 million indirect jobs in logistics, tourism, and related sectors. Shopping malls contribute approximately $650 billion to United States GDP annually, equivalent to 3% of the national economy. When shopping malls decline, it's not just retail workers losing jobs. It's the entire ecosystem that depends on these properties suffering losses. The communities that relied on mall-based tax revenue, the suppliers who served hundreds of tenants, the service workers who maintained the properties, the smaller retailers who thrived in mall environments. All of this is being eliminated. And yet, from a pure capital perspective, the market is functioning perfectly. Capital is flowing toward the most efficient producers. Simon Property Group is allocating billions toward projects that generate the highest returns. Distressed mall properties are being liquidated, and the capital is being redeployed to more productive uses. From an economic efficiency standpoint, this is exactly what should happen. Assets should flow toward their most productive uses. Capital should seek the highest returns. Markets should eliminate inefficiency. But the human cost of this efficiency is being absorbed by workers, small business owners, and communities that had no control over the market forces reshaping their environments. The future of shopping malls in America is now essentially determined. The A-class malls, typically located in affluent suburbs or major metropolitan areas, will continue to generate strong returns for their owners. These will be curated environments offering luxury retail, upscale dining, and experiential entertainment. They will be profitable and valuable. The B and C class malls will continue to deteriorate. Some will be redeveloped into mixed-use properties with residential, office, and hospitality components. Others will be liquidated for land value and redeveloped into strip centers, self-storage facilities, or multifamily housing. Many will simply be demolished, and the sites will sit dormant until new development justifies the cost of redevelopment. The regional and independent mall owners will continue to face pressure, and most will eventually exit the business voluntarily or through foreclosure. This transition is already well underway. Over 1,000 American malls have already been demolished or abandoned. Over 2,000 store closures are planned for 2026. Entire shopping districts are being erased from American communities. The mall, as the dominant retail model for America, has essentially been eliminated. The institutions, the people, and the communities that built their lives around this model are now paying the price. The final irony is that the total destruction of the traditional shopping mall doesn't actually reduce the profitability of mall ownership for those who survived the transition. Simon Property Group is more profitable than ever. The global shopping mall market was valued at $5.4 trillion in 2023 and continues to generate billions in funds from operations annually. The market hasn't collapsed. It's been restructured. The winners have become far more dominant. The consolidation has increased. The capital flows toward fewer, larger, more sophisticated operators. The economics of owning a shopping mall today are radically different from the economics of owning one in 1995. But for those with the scale and sophistication to navigate this new environment, the rewards have never been greater. This is the brutal reality of modern retail real estate. Every day that another department store closes, Simon becomes more dominant. Every struggling mall that defaults on its mortgage is an opportunity for consolidation. Every small retailer that closes is a market share opportunity for the few tenants that can afford the rents in the remaining A-class properties. The system is working perfectly. It's just not working for most people anymore.